Good morning, everyone. You are watching a live daily market outlook for Friday, 13th of April 2012, prepared by Windsor Brokers. The highlight of the past 24 hours trading is the overall weakness of the dollar against most of the majors, as during yesterday and part of overnight session, the euro and sterling appreciated against the greenback, while yen also gained, the dollar gained against yen, and the dollar Swiss kept under pressure, testing some important supports at 91 zone. Gold, after initial past 2 days, a very narrow range consolidation, bounced higher and approaching our next significant target at 1680 zone. Also, the crude oil ticked higher towards next strong barrier at $104.30 per barrel. The euro tested briefly overnight its last night strong barrier at 132.20 zone, but so far unable to break it. However, the positive short-term action of 130.32 base still remains in play. More of this we're going to see in our technical part. Highlight of last session, the Asian session, was the release of Chinese data, with the first quarter GDP growth coming below the forecast and rather disappointing reading. As said, China's economy grew at its slowest in nearly 3 years in the first quarter of 2012, with the reading weaker than expected, now raising investors' concerns that the 5-quarter long slide has not bottomed, and that more policy action would likely be needed to halt it. The annual rate of GDP growth in the first quarter slowed to 8.1%. From 8.9% in the previous 3 months, the fourth quarter of 2011, as the National Bureau of Statistics announced, below the 8.3% consensus forecast of the economists that were forecasting the Chinese release. The GDP data headlines, a flurry of indicators published during the Asian session, showing March industrial output expanded 11.9%, while March retail sales rose 15.2%, and quarterly fixed asset investment, one of the principal drivers of China's economy, grew by 20.9%. They were broadly in line with the conservative expectations of investors, who have grown concerned in recent weeks that the bottom of China's economic cycle would extend into the second quarter of the year, as it struggles to escape its worst sequential slowdown since 2008-2009 global financial crisis. This was from China. We're going to now move to Europe, as there was yesterday Italian auction. So it shows that the European debt crisis woes are slowly creeping back this week, with Spain coming closer to a possible need of bailout and pulling Italy down with it. The European markets were rather mixed, but the euro was still well supported during most of the day. Yesterday, as mentioned, it peaked at 132 zone in late hours of yesterday. As said, the Italian Treasury held a bond auction yesterday, during which they sold 2.89 billion euros of 3-year bonds, somewhat less than 3 billion that was on offer. The bonds are maturing in March 2012 and were sold at a yield of 3.89%, in comparison with 2.76% the country had to pay at the previous auction in March. 1-year debt costs had also gone up at an auction held the day before. The Italian officials mainly blamed Spain for this outcome, claiming that it was a contagion effect from the country's debt crisis. From the other side, ECB executives assured on Wednesday, one of the ECB executives, assured on Wednesday that in case of further rise in Spain's borrowing cost, the central bank might step in by reactivating its debt purchase program. He also acknowledged the Spanish government efforts to reduce deficit by introducing severe budget cuts and labeled the market's mistrust towards them as excessive. Also, the German and French governments somewhat lifted sentiment yesterday by describing Spain's reforms as comprehensive and saying that investors were overreacting to Spain concerns and that they should wait for the results of the reforms. The Italians yesterday's tender saw higher yields and lower bid-to-cover ratios in both the 3-month and the 12-month T-bonds. Also, the market labeled them as decent so far. At the same time, 10-year benchmark yields in both Spain and Italy remained below 6% threshold at 5.88% and down 9 basis points, and 5.56%, which marks down 15 basis points. From the other side, from states, rather disappointing data. I need to mention this also. From yesterday's weekly jobless claims are again ringing the bells of possible further slowing down in the U.S. labor market, as initial in the past 2 months, initially positive and rather supportive and optimistic data are now again, actually the initial optimism is now fading. The number of Americans filing for jobless aid hit again 2-month high during the last week, and more applications were received in the prior week than initially reported, suggesting again cooling in the labor market recovery. The U.S. weekly jobless claims for state unemployment benefits increased by 13,000 during the last week to a seasonally adjusted 380,000, as was announced by yesterday's labor market announcement, defying economists' expectations of a drop to 55,000. The prior week's count was revised to show 10,000 more applications than previously reported. While economists cautioned against reading too much into the report, saying that problems adjusting the data for seasonal fluctuations around Easter might have pushed last week's figure higher. They also said it nonetheless provided a worrying signal. The data comes in the wake of a report on Friday that showed the economy created only 120,000 jobs last month, the fewest since October. The unemployment rate, just to remind you, fell to a 3-year low at 8.2%, but largely as people gave up the search for work. Economists noted that the initial claims tend to be volatile at this time of the year due to shifts in the timing of Easter and the school spring break holidays, making it difficult for the Labor Department to adjust the data for seasonal variations. Another important that I would like to mention, and that's in past couple of sessions was my favorite subject, again about the oil. The top oil exporter, Saudi Arabia, is determined to bring down high oil prices, and it's working with their fellow OPEC members to accomplish that. That was announcement of the Saudi Arabian oil minister Ali Al Naimi. Just a brief look, the Brent oil has risen 13% this year, trading above $120 a barrel That was the last today, threatening a nascent recovery of the global economy. The oil has traded above $100 for oil, but a couple of days in the past year. Naimi said that they are seeing a prolonged period of high oil prices, and they are not happy with this. So they are determined to see a lower price and is working towards this goal. The influential Saudi oil minister earlier this year identified the $100 a barrel as an ideal price for producers and consumers earlier this year. Just to remind you that last year's estimation of Saudi Arabia and the bloc of the Gulf countries that are still pushing oil, pushing for a lower prices of oil was around $80 per barrel. Now they have raised it to $100, but still quite optimistic compared to the other bloc of the OPEC countries that include Iran and the mainly Latin American countries that were operating with $200 per barrel as their ideal level of the oil price. The concerns of supply shortage due to production problems in some producing countries, and as U.S. and European sanctions target exports from OPEC's second largest producer, Iran, have helped oil prices to keep much higher level. The Naimi reiterated that there were no supply shortages in the global oil market, and the kingdom stood ready to tap into the spare capacity of 12.5 million barrels per day if more crude was needed. Just a reminder, we were talking about this yesterday during also the past couple of sessions. That was quite a good point from Saudi Arabian oil minister, saying that basically he announced that there was no shortage and they are ready to intervene at any time in case of any shortage, but somehow the oil prices were still at their high levels. The Naimi reiterated that there were no supply shortages in the global oil market, and the kingdom, that's basically what we already said. The fellow OPEC producers, Libya, Iraq, and Angola, have increased output, Naimi said, and also non-OPEC members, including Canada, the United States, and Russia, had also boosted the supplies. The Saudi stockpiles at home and abroad were full, he added. Inventories in industrial countries were also filling up. Fundamentally, the market remains balanced, Naimi said. There is no lack of supply. Saudi Arabia has invested a great deal to sustain its capacity, and it will use spare production capacity to supply the oil market with any additional required volumes. The International Energy Agency said yesterday that the oil market had broken a 2-year cycle of tightening supply conditions as demand growth weakens and the top exporter, Saudi Arabia, increases the output. The agency, which advises industrialized nation on their energy politics, said increased supply and slowing demand growth might already point to a significant raise in global oil stocks. From the other side, stubbornly high oil prices could be expected to ease when the markets woke up to the shift in trend. That was the announcement from the International Energy Agency. From today's calendar, we're going to take a brief look. Okay, as said, pardon. From today's calendar, sorry for this interruption. China, as mentioned, the quarterly GDP came at 8.1% compared to 8.4% forecast and 8.9% previous release. As mentioned, also fixed asset investments grew by 20.9% as expected. versus 21.5% previous one. Industrial production was up by 11.9%, better than 11.5% forecast. German final CPI came out at expected level at also the previous release at 0.3%. Still to come at 8:30 GMT's UK's PPI input monthly release, 1.2% forecast for today versus 2.1 of the previous month. PPI output 0.5% forecast compared to 0.6% of the previous release. From America's US inflation is due at 12:30 GMT. Monthly release for the month of April is forecasted at 0.2% compared to 0.1% of the previous month, while this was the core CPI, while CPI monthly for April is forecasted at 0.2%, lower than 0.4% of the previous month release. And finally, at 13:55, University of Michigan consumer sentiment is forecasted higher. 76.4 is today's consensus versus 76.2 of the previous month release. And the preliminary University of Michigan inflation expectations are forecasted, we don't have forecast, 3.9 was the previous release. At the end of the day, 1700 GMT is time for Fed Chairman Bernanke to have his speech. A quick look at the markets and the latest developments in the currencies, major currencies, commodities. As always, we are starting with euro. As shown on the 4-hour chart, the euro is still in the steady recovery of 130.32 base, lows of 5th and 9th of April, where the good support was found. A break above initial barrier at 131.65. That was capping past couple of days price action, where is also 38.2% retracement of the down move from 133.80 to 130.32 has resulted in the fresh gains to briefly test our next strong barrier at 132, 132.20, 132.11 high was seen so far, briefly breaking above the 50% retracement and testing the next strong barrier. We have also the 20 and the 55 days moving averages on the daily chart, as well as the main bear trend line that was drawn of 142.46 through 134.85 high. We need to see break here in order to resume the current short-term recovery and the open way for a further extension higher towards 132.50 zone, which is the next significant barrier. Lows of 29th of March, as well as 61.8% retracement. From the other side, the failure to clear this level would still keep the downside in danger, with possible reversal lower, facing initial support at 131.65. That has already been tested, and the next supports are coming around the 131 zone, below which we'll have minor support at 130.50, and then a key near-term support at 130.32. As set, as long as holding above 132, 132.20 zone, there is still a risk of further extension, risk of a lower top and further extension of the short-term downtrend from 133.80 zone, where the recent gains were capped, better seen on the daily chart, with the risk of retesting the key and the critical support at 130 zone. That covers low of 15th of March and the low of 16th of February at 129.73, and that also marks the two months range floor from the beginning of end of February, end of January, beginning of February, and the loss of this important support might trigger further weakness of the euro and the possible test in the short term of yearly low at 126.22. On the upside, as mentioned, clear break above 132.20 opens next barrier at 132.50 ahead of 133.00 and 133.80. That is our key short-term barrier on the upside. The cable is also in steady recovery of higher base at 158 zone, where the temporary support was found. With yesterday's rally above 159.30, that was initial barrier high of 10th of April, also 50% retracement of 160.61 to 158 descent. Breaking above 61.8% retracement, hitting 159.84. Currently, the pair is in the corrective pullback with initial support at 159.30, previous high of 10th of April, also the 55 days exponential moving average expected to contain in order to keep immediate bullish structure intact for possible attempt towards 160. 159.84, the previous high of yesterday, is initial barrier, and then we have 160 as the psychological resistance, also high of 27th of March, for a possible final push towards our key barrier on the upside, 160.61, yearly high posted on 2nd of April. On the downside, set 159.30-20 zone is the initial support, while break below 159 and 158.80 would ease the current bullish pressure and allow for a deeper reversal. On the larger picture, the latest break above 200 days moving average that was briefly tested and broken during the past week, and sustained the break, and holding above this level keeps the upside in focus, as also the price action holds above the main bull trend line, currently at 158.10-20 zone. Basically on the downside, 158.40 and 158.00 is our key support, and the only break below these levels would significantly weaken the structure of the cable, and open next levels at 157 and 156.50 for test. Dollar yen is taking a break of its recent pullback of 84.17, yearly high posted on 15th of March, as the latest reversal, the latest action lower dipped as low as 80.57, testing our next target. That was the higher platform of 6th and 7th of March 2012, where the temporary ground was found. This recovery is now underway. I would say rather consolidation, as 81 zone still holds the upside. There were some brief breaks higher. 81.18 was seen during the overnight session, but a quick reversal below 81 zone keeps this range trading still in play. The hourly studies are neutral, while the 4 hours are still in the negative territory, as 20 days exponential moving average holds the offers immediate barrier on the upside, currently at 81.04, ahead of a more significant high of 81.85, and also the 55 days moving average at 81.57, along with the low of 3rd of April, and then high of 10th of April at 81.85, that are basically expected to cap the upside, as structure on the daily chart remains fairly negative for now. 55 days moving average on the daily chart keeps the downside protected, and would allow for some further consolidation. Only break above 82, firm break above 82 barrier would ease the current bear pressure and allow for some stronger recovery. Pardon, key barrier on the upside 83 and 83.30, and only break above this level is to confirm an end of corrective action and refocus levels at 84 and 84.17. Dollar Swiss is trending, near-term price action is trending lower of 82.21, high of 5th of April, where the recent recovery attempt of 90.00 base was capped. The yesterday's fresh low was posted in the 90.90, and if you remember yesterday, I mentioned that loss of 91 support zone would significantly weaken the structure. We have seen so far 90.90 just ahead of 90.86. That marks 61.8 retracement of the latest bounce from 90 to 92.21. Seeing more potential towards the downside, as studies on the 4-hour chart are still in the negative territory, and the price broke below the moving averages. Immediate barrier of the current bounce of 89.90 that so far hit 91.32 is at 91.39 and the 91. So I would say 91.40 are moving averages, as well as previous range floor, and only break above, firm break above these levels would avert immediate downside risk, and likely open way towards higher levels with the 91.80, 92.00 to come in focus. Otherwise, most likely scenario would be the lower top at around or below this level, as the hourly studies are also still in negative, and it seems they look toppish at this point, so holding short just below our barrier at 91.40 zone, and most likely would be the lower top and the further extension lower that is looking for a full retracement of the 92.21 corrective ascent. The situation on the daily is improving in a way, but still we need to see clearance of 91.30, where is the 20 and the 55 days moving averages, along with the 91.40 our strong barrier, in order to signal some stronger gains. Otherwise, the outlook might still stay turned towards the downside, as the range is narrowing within the current triangle. The key barriers on the upside are 92.21, the previous high of 5th of October, part of 5th of April, where is also the main bear trend line of yearly high at 95.93. Pardon. While on the downside, initial support is at 90.22, where is the main bull trend line, and the triangle support ahead of 90.00 base lows of end of March and beginning of April, and the loss of this level would further weaken the structure and signal a resumption of the downtrend from 95.93 for possible test of the strong support zone at 89.30 end of February double bottom, and below this 88.80 is the 200 days moving average. Gold, as mentioned at the beginning of the presentation, pardon, regained the strength as the dollar weakened during the past 24 hours. It ended actually its past 2 days narrow range consolidation just under 1663, previous high posted on 10th of April, with the fresh strength. Now this morning's action shows a regain of our next strong barrier at 1683. It's the previous high of 2nd of April, as well as this point just below this was the main bear trend line of 1716, high of 12th of March 2012, keeping the structure positive. The studies are approaching overbought zone on the, actually the hourly studies already peaked in the overbought zone and currently are reversing lower. That might signal some corrective action ahead of fresh strength, while 4-hour outlook holds the positive tone, with momentum being close to its extremes. As the RSI is starting pointing lower, and again this might be a signal of some corrective action. Immediate and strong support lies at the previous range of consolidative range at 1660 zone, where is also the 20 days moving average on the 4-hour chart, with the break of 20 days above 55 days giving a positive signal for further extension higher. On the upside above 1686, that was the today's low posted early this morning, opens next significant barriers 1684, and then 1697 and 1700. The 1697 is the high of 27th of March, and the 1700 as around the figure resistance. On the upside, above this, we have 1716 high of 12th of March, and the 1725 1st of March high, as well as Fibonacci projection 161.8 at 1727. That would be our target in case of a firm break above 1700. Overall, on the daily chart, the studies are improving as the initial barrier was taken out. We need to see the break above, as mentioned, 1695. What is the 200 days moving average? 1697 and 1700, in order to confirm the latest positive action of 1612 low of 4th of April 2012. So the near-term price action remains in the positive field and keeps the upside in focus, with the corrective action so far seen to be contained at around the 1660 zone in order to keep the immediate bulls in play. Crude oil hourly chart shows the past 2 days recovery of the recent low at 100.67, when the pair in its descent of recent peaks at 109.90 and 110.53 came closer to our downside target at $100 per barrel. Initial loss of the support of 103.72 previous range ceiling has triggered this weakness, and 167 seen so far. Studies on the daily chart remain negative and still pointing higher, as also we can see that 55 days moving average is still limiting the upside, as the recent recovery attempt reached so far 104.22, coming close to our strong barrier at 104.30 that marks the previous range floor, and only firm break above this level is to open way for a more significant recovery and open way for a test of 105 zone with 105.45 high of 2nd of April to come in focus. On the downside, the previous high at 103.38 has already been tested, as the pair is pulling back off its yesterday's peak at 104.22, with the low so far seen at 103.07. Loss of 103 handle and 102.87. That is 55 days moving average on the hourly chart would again weaken the structure, while next supports are at 102.40 zone, along with the 102.30, where is the near-term bull trend line. Loss of these levels is to signal an end of the current, to signal the top at 104.22, and they're likely to refocus levels on the downside, as I mentioned, the overall picture on the daily chart is still in the negative. Studies are still in the negative territory, and the downside remains vulnerable, with our main target at $100 per barrel still in play in the short term. That was all for today. Thank you for attending our live daily market outlooks. We're back on the next week, Monday morning at the same time at 7:00 GMT. I wish you a nice day, nice and relaxing weekend, and very profitable trading. Good luck.